Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing that we need to do is open up our brokerage platform and navigate to any equities underlying. We've got GLD up at the moment. Let's have a look at MVO. We've got positions on both of these underlyings. Any underlying, it really doesn't matter. We just want to navigate over to see a list of expirations for that underlying. Now, the purpose of this step here is to simply find an expiration date that we're going to use to mock up future positions moving forwards. And all equities underlyings basically have the same expiration dates, which is why it doesn't matter which one you choose. So the one that we want to select needs to be between 30 and 60 days out in time, and it also needs to be a monthly, not a weekly or quarterly expiration date. Now, the only expiration date that fits that criteria, as you can see, is January 17th, which is 39 days out away. So we can take that information, 39 days, come over to our watch list and simply filter out any and all underlyings that have earnings over the next 39 days. Earnings will increase volatility, it will almost certainly mess up our deltas, and both of these things will have a negative effect on our P&L, so we want to stay away from it. Also, we want to filter out anything that has a low liquidity rating level. The reason for this is because we want to be able to get in and out of positions easily. Therefore, we only want to be trading highly liquid underlyings, and underlyings with highly liquid options markets. But also because the more liquid the underlying is, the tighter the spreads are. So we'll be paying less to get in and get out of these positions as well. So, with that being said, you'll be left with something that looks like this. This is a pre-made watch list. You can use any watch list that you like. It doesn't really matter what you choose. And I personally like to order everything from high to low, IVR. The reason for this is because we want to sell premium or write contracts when IV is high. Volatility is a mean reverting product, so we want to sell it when it's high and then play the contraction back down to the mean and hopefully further below from there. Now, at the top here, we've got NVO with an IV rank of 90.6. We've already got a position on NVO, and we just want to, so we're not going to look for another one on NVO. However, NVO, if you don't have a position on NVO, by all means, go for it. It's at the top of the list. But at this point, we just want to see what would fit well inside of our portfolio. So as you can see, on the side here, we've got a couple of futures positions, GLD, NVO. This is just a small example portfolio, so I'm just going to assume that your portfolio is empty and you can choose whatever you like. But if you have got positions in your portfolio, say for example, if you've got 10 positions and 8 of them are in the tech sector, that's not a good idea in the first place to have that many, to be that heavily weighted in the tech sector. But let's say you are in that situation, your 11th position then shouldn't be in the tech sector. It should be something completely unrelated. So you can use things like beta weighting, you can use the correlation to SPY. But I mean, as long as you use common sense, you'll be fine. Use these things, that's also fine, but common sense prevails. So, with that being said, you want to see, as you go down the list, you want to see what um, what's trading for a good price. And what do I mean a good price? So for example, if we look at Nikola here, it's trading at $1.52. It's going to be very difficult to actually find a good position, even though it's got a high IV rank, very high absolute IV level. It would be difficult to actually put a position on this because our strike selection will suffer. So if I just show you here, I mean, there's our strikes. This is where the price is between $1 and $2. I mean, there's really nothing to do here. So for example, Tesla is trading at $400. You're probably not going to want to. You probably won't be able to put a naked position on Tesla unless you've got a very big account. But even then, you'd probably be better off just buying some wings just to cover yourself and reduce buying power requirement. And in fact, I'll show you what that looks like. So Tesla, it's trading at $400 right now. The market's just open. Market's moving as it normally does in the first half an hour or so. It's got an IV rank of 68.6. and it's got an absolute IV level of 65.8%. So obviously Tesla being what it is, it has a nice and high IV, which is excellent for us. So we come over to the expirations, and January 17th is what we chose, and this is now the options chain. So what we're going to do here is simply sell one call and one put. Very simple, and we want to sell it. We want to sell them anywhere between a 15 and 20 delta. So this is a delta column. We've got a 20 delta here. We want to sell that at the 495. And we've got the delta column here on the put side. We've got a delta of 19 and 21. Let's be slightly. Oh well, the delta's just changed in real time, so we've got a 20 delta now at the 345 strike. So you've got a range here between 345 and 495. Now, as long as price stays within this range, um, by expiration, then we will keep 100% of the premium that we collect up front. And the premium that we collect up front is this here, $18.17. This you need to multiply this out by 100 because each contract controls 100 shares. So the premium that we collect would be $1,815, or just over 1.8k. Now, the probability of that happening is 66%. We've got a probability of profit of 66%. Well, technically, the probability of profit is the probability of making at least a penny by expiration. But IV is pretty much always overstated. So your actual probabilities are higher than this. This is just your expected probability. Now, if you want to get out 50% of max profit, which I think is a good idea to do, you've got an 80+% chance of that happening at some point between now and the expiration date. So you've got some very, very high probabilities of success here. We're pretty much delta neutral on the trade. We get $58 of daily theta decay. This would increase as time goes on, assuming all else stays equal. And our broker is going to require just under $16,000 in buying power to open this position. Now, as we mentioned, $16,000 is probably a bit too much for most people. So, what we're going to do is simply buy another contract a little bit further out. We're going to buy a wing. We're going to buy a long contract. We're going to go long on a contract, sorry, to cover our short position here, $5 wide. And we can also do the same thing on the put side, $5 wide. And that's going to reduce our buying power requirement massively because now our loss is no longer unlimited. It's now defined between the difference between the strikes of our short and long contracts minus the premium that we collect up front, multiplied out by 100 shares per contract. That's how we end up at our max loss here of 330. And our broker knows what our max loss is, so it only needs to hold that much in buying power to open this position. Now, if your portfolio is slightly larger, you can, of course, just make it $10 wide on either side. You'll collect more premium up front. You'll enjoy a slightly higher probability of success. The wider this is, basically for a naked position, you'll have the highest probabilities of success. The tighter your wings are, the lower your probability of success, but you'll have a higher return on capital. That's your trade-off. And the wider you go, let's say you go $20 wide, you'll now have even higher probabilities of success, but your buying power requirement will be higher. Your return on capital will be slightly low, but your net premium you collect overall will be higher. Your average daily P&L will be highest on a naked position. That's just how it is because you take the most risk that way. You get nothing for free in the market. If you want to make more money, you have to take more risk. And it's our job to manage that risk appropriately. So this is how you can find and manipulate positions to fit inside your portfolio. Now, how do you know how much buying power you should be allocating to your positions? Well, we've created a free position sizing template. Link is in the description. Just click this button here. And this is what it looks like. So you enter in the size of your portfolio. Let's say if it's $50,000, you're entering what the current VIX level is. I think it is around 14 right now, so we'll leave it at that. And then everything will then be calculated for you automatically. It will tell you what the maximum amount of buying power is that you should be allocating to any single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general, And as long as you follow this outline and use it to form the backbone of your portfolio over the long term, you will be absolutely fine. There's also an explanation here of how everything works. Again, link for that is in the description. If you want to learn in more detail about what we do and how we do it, link is in the description. This time, click on EDS Premium. Get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, the adjustments that we're making, all in real time. There's also a full course, so no prior knowledge is required. We will teach you absolutely everything that you need to know from start to finish. If you get stuck at any point, it is a private community, so you can speak with myself directly or with other like-minded individuals. And there's also a 100% money-back guarantee. So once you have studied our full course and followed our trades for at least 6 months, if at that point you aren't profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part. It's £1 a month to join right now. We've just launched. That's why it's so cheap. The price will be increasing. However, once you're inside, the price is locked in for you for life. So you are definitely rewarded for getting in early. And the goal here is to have you on board for 6 months to a year. You're always welcome to stay for longer. But within 6 months to a year, you should be at a point where you know what to do and you don't need any external help, and you've learned the skill and you can do this for the rest of your life to generate income for yourself, income or returns, whatever you want to call it. Um, but that's the goal here, 6 months to a year, and you should be self sufficient. Now, with that being said, I will see you guys on the inside.